Hi guys, and welcome back. We are now on chapter 7. Chapter 7 is not a long chapter. I basically took from it what we need to move forward. The next 3 chapters about the market structures, those are really at the heart of microeconomics, and we're going to be focusing quite a bit on those. And this one is like a stepping stone towards them. So it's not really a long chapter by any means. It's the shortest chapter we're going to have, and so here we go. Let's begin with a basic question. What's the bottom line of business? Why are businesses in business? To make money. And money is a general term and we have to refine it. So we say profits and more profits. They're there to make profits. If it wasn't about profits, it wouldn't be business. So then how do businesses make profits? Well, businesses have 3 avenues. I purposefully put price all the way over here. And I'm going to actually, even though it's 3, I'm going to say it right off the bat. This is the one that is the least likely place to go. Now, is it possible for a business to increase their prices and actually increase their revenues? Yes, of course. It's called inelastic demand, right? So if a business has a lot of brand loyalty, very tight elasticity, then it is possible for them to increase their prices and actually make more money. Apple does it all the time. However, just remember that for most businesses, and what the demand is typically elastic, of the 4 P's, and I don't know if you learned this before in marketing, of product, place, promotion, and price, of the 4 P's, the one you touch last is price. Why? Because it's volatile, and because it can irritate consumers, and because of the law of demand, where that tells us there's an inverse relationship between price and sales or purchases. So the odds are, if you want to make more profits, your avenue should not be to raise prices, but obviously you can. And we're seeing it now as high inflation is abounding, that some businesses are taking advantage of that and actually abusing it by increasing prices unnecessarily above and beyond what they need to. We are seeing it with gasoline, we're seeing it with oil companies, we're definitely seeing the abuse. So it's possible to increase prices and make more profits, but it isn't the most common way, and it isn't usually the best way or the way that actually is most effective. So it's way over here. The one that is most effective is reducing costs. So reducing costs and increasing sales is what companies want to do. So these two, the combination of these two is best for companies. Let's focus on reducing costs. Now, why are reducing costs the best way to increase profits? So long your sales are also growing, is because it's internal. It's completely within the control of the company. The company doesn't have to make a change in a product that may or may not entice a consumer, may or may not increase demand for their product, and therefore sales and eventually, more units times the price kind of thing, also revenues. But this is rather completely out of sight for the consumer. The consumer isn't aware of behind the scenes effects, and then the consumer continues on purchasing as before and is insulated from it. And so the company has much more control. Now, the other thing that's interesting about reducing costs is, if you notice here, I say can require upfront costs, might not require upfront costs. Not all the means of reducing costs require some sort of initial investment. Now, if the company is doing something like replacing labor with capital, they're automating, or they're using, increasingly artificial intelligence, yes, there's going to be an upfront cost. No two ways about it. But if they're doing something like laying people off or swapping out one part of their raw materials with another cheaper parts, those might not actually lead to upfront costs. So it is possible for a company to increase their profits per unit without necessarily spending much money when they are looking to reduce costs. Or they might have to spend money, but it's more of a guarantee that they're going to see a reduction per unit as far as costs go. Increasing sales is a bit more of a gamble, but clearly a company needs to do both. Reduce the cost per unit, but also raise the number of units they're selling. It's best in conjunction with reducing costs. That's why I have this note here for you. It's rather external. What does that mean? You are at the mercy of the consumer responding to you, because the way you increase sales is you end up playing with these things. I would say reduce the price, but that is very short term. It's not sustainable. And if you remember from chapter 6, when we talk about marginal utility and we talk about there is such a thing as a limit to how much more one of the or the same individual can buy from you, there's only so much that the price can do. So what you end up doing is spending money on things like advertising, promotions, repackaging, new distribution channels, new and improved formulas. You can see how any of these efforts are going to require upfront costs. And so we're definitely looking here at, if we reduce costs, we may or may not have to come up with upfront costs, and the outcome is more guaranteed. With increasing sales, you definitely are coming up with upfront costs, you have it, and the outcome is less guaranteed. It's external versus internal, but those are predominantly the mechanisms. Now, if you are a company who can reduce costs, increase sales, and increase the price, my God, are you golden? But, that's not going to be a very common thing. Now, what's the difference between how economists measure costs and how accountants measure costs? So these two left columns are about economists and the two right ones are about accountants. Here's the thing about accountants. Let's start here. We're all familiar with it. We've all taken accounting, right? Accountants measure all the explicit costs. Now think of what the word explicit means. It's something that's obvious. So what are the obvious costs? Those are the costs that will find themselves into, to a spreadsheet. The rent, the utilities, the labor, the innovation, the design, the IT incorporation, the hardware that you have to buy. All of that is explicit and obvious costs. So explicit costs equal actual costs. This is what you will find if you're looking at an income statement or spreadsheet for a company. Economists don't just measure explicit costs. They also measure implicit costs. And, also think of it as also, not just in alone. And they do focus on a unique kind of cost called opportunity cost. Because if you remember what opportunity cost is you have to forego B for A, therefore B could have benefited you. Now it is not benefiting you. That needs to be offset by the decision you did take. Implicit is subtle. So if I said to you, what is implicitly said, I'm saying read between the lines. What is not obvious? So economists look for the not so obvious costs and tag them on, while accountants do not. So here are some examples. Let's look at accounting for a minute. Let's take COVID-19. COVID-19 has forced many businesses to shut down for a deep disinfecting clean, right? If you ask an accountant how much is that deep disinfecting clean is going to be, they're going to say, well, you're going to hire a company to come and do it, and the bill is $5,000. Therefore, your costs are $5,000. If you ask an economist, is my bill $5,000? The economist is going to say, what will this shutdown cost you in could have earned but didn't? Would have benefited, but now it's been foregone. And so what we're going to say here is, okay, the deep clean is $5,000, but there's a loss of revenue because you're shutting down your operation to clean of $12,000. Did you lose $12,000 out of pocket? No. But would you have gained those sales had you actually been in operation and not have to shut down to disinfect? Yes. Therefore, to an economist, you're not looking at $5,000 in costs, you're looking at $17,000 in costs. And that is the difference between how an economist thinks and how an accountant thinks. Now, do these costs find their way into an actual statement that you can look at? Yes, and that is what economic profit is about, and that's what we're going to talk about. But typically, when we're looking at a company's revenues and a company's income and a company's costs and expenses, we are not looking at the implicit. That comes as part of the analysis, not necessarily as part of the functionality. I'm going to stop this video right here. When we come back, I will resume with video 2. Believe it or not, it is only 2 videos for this course. No, not course, for this chapter. Okay, see you in a bit.